The stock market has evolved greatly over the last 100 years, and there's always been this one main thing, the one primary thing that hasn't changed over the market over its lifetime. Now, if you know the things that are stable in the stock market, you're much better at predicting future price cycles, or the things that you don't really have to worry about, or the things that you can focus on to capitalize on your investments or future trades. Hey, I'm Sasha Evdokov, and I want to give you a little background about the last 100 years in the stock market so that you can understand the things that are stable in the market in order to capitalize and trade better. Thing is about 100 years in the stock market, things were all done based on tickets. You would exchange ticket prices in order to purchase stock. Also, your prices were dealt in quarters or fractions. So for example, if you wanted to purchase a certain stock, it wouldn't be $50.21 or $50.25. It would be $50 and a quarter or $50 and 3/4. So this is the way purchasing was happening. You also had stock certificates. Now, currently, if we fast forward things over the next 100 years, things are done in decimal format. We also have the evolution of high-frequency trading just because the sheer fact of the internet boom. Not to mention, you don't even have stock certificates anymore. Everything is done digitally. So a lot of things have changed in the markets over the last 100 years. But the one main thing that has been stable is human behavior. If you listen and watch human behavior and see how it's applying to the stock market, you'll be much better at predicting these future trends. Now, I'll give you two examples regarding the human behavior factor of how it applies to the stock market. So the first example is the seasonality example. Currently, in the stock market, it's summertime, and in the summer, what happens to the market in terms of volume? Are people investing, or are they going into trips to Europe? Right now, you see a lot of people traveling. They go abroad, spend time with their family because the weather is nice. And this is what happens, is that the market in the summertime, typically, whether it was now or 100 years, the market volume and the market activity dies down in the summer. Now, during the winter times, such as, Thanksgiving, Christmas time, people are more joyous, they're more happy, they get bonus checks, companies get to see their profit and loss reports, and hopefully most of them are doing well, so that way people get, compensations, or they feel the additional revenue or money that they have in their bank account, they feel they can do something with it if they have the extra income. So that's the first human behavior, is the cyclical or the seasonality behind the trends of, the winter months, the summer months, and how it applies to the market. It was the same 100 years ago, and it's pretty much the same today. Now, of course, we have more volume now just because more people are more active in the stock market and with the computer algorithmic trading. But in general, the market dies down in the summer because of human behavior, and it increases its volume and activity during the winter months. Now, the second example is to watch for an influx of a baby boom. So you may have a huge influx of babies being born in a certain time period when the season was cold and people just had an influx of baby booming happening. So when this happens, people have less disposable income over the next 5 to 10, 15 years when they spend money on their children. So for example, you may be spending more money on diapers, on doctor visits, on a lot of other things that are related to your new family member, and you have less income to invest in the markets. So when this happens, everything slowly dies down as well when there's a huge rush. And this could be country dependent, it could be worldly dependent, depending on if there's a huge boom in the world or a huge boom just in the US or a huge boom just in Europe. So different markets could be affected differently, but typically when there's a huge influx of children, people have less money to invest, and they may put in less money into the market or to invest just for the sheer fact of that they need that additional income to raise their new family member. So those are two examples in terms of human behavior and psychology of how human behavior is the one main constant in the market. Normally, the market evolves much more rapidly than we humans do. And if you pay attention to these cycles, if you watch these cycles, if you listen to them and you look at them very closely, you're able to predict trends of what will happen to the market in that sense. Will the market slow down? Will the market accelerate? And that will give you a huge advantage. But it's a longer term play. It's not a short term play. It's not a computer algorithmic, because the change is very slow. Thank you for watching. If you enjoyed this video and you want to see more videos like this one, and you want to sign up to see my rapid recap and get the stocks that I'm watching in the current market conditions, go ahead, enter your name and email address at this link. Just click it and you'll get my rapid recap as well as my newsletter weekly. And if you want to see more videos, more courses and training material to take your trading to that next level, some in-depth material that are 4, 5, 6, 8 hours long, then go ahead and check out some of the courses that I have at tradersfly.com. Thanks for watching, and remember to do what you love, contribute to others, and most importantly, live life abundantly. I'll see you next time.